This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Hello, and welcome back to Fintech Recap, your favorite podcast. I know that it's your favorite podcast. My name is Alex Johnson, but I know the reason it's your favorite podcast is because Jason Mikula, publisher of Fintech Business Weekly, is my co-host. And Jason, you are back once again to break down the news with me. How are you, sir?
I'm doing pretty well. It's been an interesting time in the Mikula household. My better half has been away, and so it's just me and the dog, which I'm just, to be honest, not used to.
I will tell you something. One part of my life that I probably don't think I'll ever really get back is the me being in my house by myself thing. I'm never in my house by myself. Like, I'm either working, or there's kids running around, or my wife is taking care of the kids at home. But like, I don't even know what it would feel like to be in my house by myself. You're making me like jealous now, Mikula.
I wouldn't be too jealous, because the side effect has been that I just work more. It's like, oh, no one told me that we should eat dinner, and now it's 8 p.m. and I'm still reading some weird, banking regulatory stuff. I guess I should stop working.
That is a fair point. That is a fair point, particularly in this sort of age of like remote work that we all are now living in. You kind of need someone to like drag you away from the computer. So I can definitely empathize with that. That does make sense.
But speaking of households and family, how is it that we've been podcasting for 3 years and you've never mentioned that fintech runs in your family?
Yes. Well, I think this came up recently on our group chat offline. But yes, for people who don't know, I started my career working for a fintech company that was based in Bozeman, Montana, where I grew up. Not a lot of fintech companies here, so it's kind of a lucky chance. But the reason I went to work there is my dad was the vice president of product development, and I've worked in fintech for I guess 20 years now. He's worked in fintech for like 35 years. And we have actually had the opportunity to work at multiple different companies together over the years. In fact, about more than half of my career in fintech has been spent working with him in some capacity. So yes, fintech definitely runs in the family. If anyone ever needs any consulting on credit decisioning, that's my dad's bag. That's what he knows better than anybody. And so it's also why it's one of my first loves. And speaking of which, Mr. Mikula, it's not entirely irrelevant to our conversation, because you just got a new job as well. Can you tell us about it?
Yes, absolutely. It was opportunistic. A lot of folks have asked me over the past couple of years, would I ever get a real job again? And lo and behold, I started earlier this month as the head of industry strategy, banking, and fintech. Which is a mouthful.
That's a good title, though.
It is. At next-gen decision engine platform, Tactile.
Yes.
So I'll be working with them to support product strategy, go-to-market, and communications in use cases for fintech and banking, which actually, quite interestingly, I always thought of these kinds of platforms as specific to credit, but they can actually be used across the consumer, or across the customer, I should say, life cycle from sort of decisioning when you're onboarding. So like KYC, KYB, obviously fraud use cases, credit, as well as on the servicing side. So I'm very excited to experience a different side of the banking and fintech landscape. I spent my whole operating career slanging loans, marketing and doing product management for consumer credit. Yeah. So to be on the sort of infrastructure side is going to be a new experience for me.
Well, that is very, very cool. Congratulations on the new role. I am a fan of Tactile and have done work with them through the newsletter and have gotten to know them. It's a great company. It's a great fit. And the fact that you're like becoming an even deeper like credit decisioning nerd is great. So if you ever want to like nerd out on credit decisioning topics or decisioning across other use cases, let me know, because that's like, I feel like the one area in fintech that I actually know. You know what I'm talking about?
But
Like
is your dad going to join the? But is your dad going to join the call when we discuss?
Well, that's what I think we should talk about is like maybe we do a special podcast in the future where we just like do a deep dive into credit decisioning and bring on all the nerds together. So no, I everything is coming full circle. This is fantastic.
Love
and
it.
speaking of coming full circle, we are also going to be in person together relatively soon, which
Yes.
has been a while since that's happened. Can you plug this for folks who are maybe also going to be traveling?
Yeah, absolutely. So we are descending on Gotham, New York City for Finovate.
Yes.
This is actually my first Finovate, believe it or not. So I'm pretty excited
Is it
to experience.
really?
It is.
Oh
somehow
my gosh.
I've never attended one, either timing or travel or what have you.
Oh, Finovate rules.
I'm super excited. I will be on stage 3 times.
Whoa!
So the session that you and I have together is going to be moderated by none other than Jason Henricks.
Yes.
One of our favorite bank nerds, Kia Haslett from Bank Director, will also join the panel, as well as Barb McLean from Coastal Community, Alan Denson from Morgan Lewis and Bacchius. I hope I said that right. And I feel like there was like another panelist that I'm forgetting that may have gotten a late edition.
It's a big
going to be a lot. Yeah, it's a big group. Live recording of Breaking Banks podcast. And yes, we are talking about banking as a service, which I guess we'll spare you in this episode. BaaS Island has been pretty quiet. So we're taking the month off from that.
We are, yes. We're like on the boat that's like driving by BaaS Island really fast, and we're waving, but we're definitely not going to be stopping there because we have lots of other news to discuss.
Yes.
And actually, you know, an adjacent acronym to BaaS would be BNPL. So, Mr. Mikula, why don't we start with Klarna, if you don't mind?
Yeah, absolutely. So our news story on Klarna is the launch of what a lot of media publications refer to as banking. Spoiler, in the US market, what Klarna is offering certainly is not banking. The feature is called Balance, and it's basically a wallet that lives within the Klarna app. It is worth noting that in the EU, Klarna does hold a bank license in its home country of Sweden.
Yep.
And if you look at the terms and conditions, which frequent listeners will know that I love looking at some terms and conditions, the offering in the EU essentially is a bank account. You know, you can fund it, you can withdraw the money. It is protected by the Swedish deposit insurance guarantee scheme, which goes up to like 1 million Swedish kroner.
Wow.
Which is about $100,000.
Yep.
And it earns interest. So I mean, basically, it is fundamentally it's a bank account for all intents and purposes.
Yeah.
The US product, however, is literally a gift card. If you look at the T's and C's, it describes it as a gift card. The industry term being stored value.
Yeah.
And importantly, you can add money either from an external account, although I set it up and I was not able, it doesn't give me the option to fund it from an external account, or from cashback and refunds from using Klarna. Notably, as a stored value product, there is no deposit insurance. So if Klarna were to go bankrupt, which I don't anticipate happening, but if that happened, you would become an unsecured creditor in Klarna's bankruptcy. And you cannot withdraw or refund as cash money that is being held or value that is being held in that account, and there is no interest. I know this is a little like inside baseball-y, but my first sort of like question or reaction to this story is like, what is the deal with all of these media outlets, in my opinion, just getting this story wrong? I mean, I think Bloomberg, which I will pick on, the headline was like, Klarna poised to compete with like Bank of America. And I'm like, I'm pretty sure that is not what is happening here.
Yeah. Well, no, I mean, it's a good point, right? Because there's a message that's being pushed by Klarna, right? And I think I wish that media publications would take more of this with a grain of salt, because what's happening here, and I don't blame Klarna's executive team for this. They're doing what they're supposed to be doing, but like they're putting out a story that's laying the groundwork for an IPO, right? That's what's happening. And apparently, and this is the part I don't get, like maybe they think public market investors are stupid. I'm not sure, but like this idea that the best way to set up Klarna's IPO is to position Klarna as, and this is like literally what they're talking about when they do press interviews around these types of product launches. We want to be a global bank, is how they're talking about it. And so to your point, Jason, we are going to launch this bank account feature in all of these different markets. Now, in the EU, it is a bank account because they have a banking license. They can offer a full bank account. In other countries, and again, like just Europe and the US does not count as global. Let's like also make that very clear.
So the very Western orientation. Oh yeah,
right.
we got it all. Western Europe and the United
like
States.
The two markets we care about. So I mean, like that's not a global bank, even in like a JP Morgan Chase sense. Like any large bank is going to reach into many more countries than that. But B, there was a way that they could have launched more of a true bank account type product in the US and in other regions via partnerships with banks and the dreaded banking as a service acronym. And, I mean, Klarna, unlike many other smaller fintech companies that are having a difficult time with banking as a service right now, Klarna certainly could have gotten a bank partner that's not under a consent order. They could have launched a bank account that offered many of the same features, probably not quite at the same attractive unit economics since they'd need to go through a partner. But like, again, for Klarna, they could have done it. I would hazard a guess that the reason they didn't do that is a combination of two things. One, they are sort of rushing towards this IPO and trying to lay all the groundwork for it. And so it's better, I would imagine, from their perspective, to have the story they can tell the market and do it in a coordinated fashion globally on a schedule that works for them than it is to go, yeah, we have a bank account in Germany and in Sweden, but we don't have one in the US, but it will be coming. Like, it's a better story to just say we're globally rolling out this bank account everywhere at the same time. And going with the stored balance approach allowed them, I would imagine, to move faster in doing that. The other component to this, though, and this is the part where I wish Bloomberg and others would have been more skeptical and would have pushed back on it, is, and I have this sort of take globally with BNPL, not just with Klarna. It's really difficult to be a bank if your primary customers are merchants and your value proposition to merchants is getting consumers to spend more money than they otherwise would. That is by itself not a bank from a product or a value proposition standpoint. And if you go to Klarna's mobile app or website, it really is much more like Amazon than it is like a bank account or a mobile banking app. And again, that's by design. That's how they make money. There's nothing wrong with that. They are a commerce enablement platform. That's their value proposition. But when we tack banking features or banking capabilities, again, not a bank account, but banking features onto that commerce enablement platform, I think we have to analyze that from the perspective of what is in the best interest of a platform that enables commerce in adding these features, not is this a bank account because Klarna is saying to the market, we're going to be a global bank. That's just a talking point. That's not reality. And, the analogy that people drew to this, which touches on an area that I think you want to rant about later, is Starbucks. And Starbucks obviously has a stored value account, and they allow you to put money into your Starbucks account. You can only take it back out via purchases with Starbucks, so it's only redeemable for coffee. And I do think that is a very good analogy to what Klarna is doing in the US. This is going to be a great feature for helping people shop more within the Klarna ecosystem. It's going to be convenient. Apparently, you get cash back. That's kind of one of the incentives for keeping money within this account. It's a faster way to get refunds and to be able to just sort of transact within the Klarna ecosystem. So it is definitely going to be valuable, and it's going to be something that I think is going to make their ecosystem stickier. And for power Klarna users, I think it'll be a good thing. but let's not call this a bank account, and let's not even pretend this is like advancing a vision of banking. This is advancing a vision of commerce.
No, I think that makes a lot of sense. And I mean, I I know the the Starbucks example is just so overused to the point that I never want to say it again.
You'll notice I didn't say a specific thing when I was doing that.
I mean, I think the lesson that I always draw from that is, when does it make sense for consumers to use a wallet like that, right? Yeah. And the two threads I always pull on there are like, one, frequency. Yep. Right. So to your point, like, is somebody who uses Klarna once or twice a year going to bother with this? I would assume that's not the intended audience. The intended audience is, the power user who's using Klarna as a shopping app, right? Yeah. They're, instead of opening up Amazon on their phone or opening up, I don't know, wherever people shop. I clearly don't buy a lot of clothes. They open up the Klarna app.
Yeah.
And then the second piece, though, to make that attractive is you still have to give somebody a reason to use that instead of just having a linked payment card, right?
Yeah.
Like I've been using more Uber Eats than I care to admit while my better half is out of town. But like, I think there is an Uber wallet, actually. I see no need, at least personally, to use that unless there's some incentive that drives me to do so, right? The Starbucks example, the incentive is you get whatever, one every 10th coffee or whatever it is, free.
Yeah.
Is faster refunds a good enough incentive? Maybe, if you're using it like a lot.
Well, and the cashback seems very like uneven to me. Like when I was looking at how they were describing it, it's kind of like on a merchant by merchant basis. Like, it's not like, oh, you get 5% everywhere all the time or something. So it doesn't seem super compelling that way.
So I'm perfectly happy to be proven wrong, but based on sort of the current formulation, I'm not sure I see enough value that it's like a attractive proposition for a person, particularly, by the way, if you're lower income or liquidity constrained. Like, do I really want to have money locked up in this Klarna account that I cannot take out if I need it, unless state law requires that be an option? I admittedly don't know what states might require that. If you're living paycheck to paycheck, you probably don't want to basically reduce the utility of money that you have by locking it into this gift card where the only thing you can do is spend it on Klarna. On Klarna merchants, rather.
Yeah, I mean, that's a really good point, because and that gets to the difference between Starbucks and Klarna. Like, Starbucks is I would say, generally slightly more affluent audience, where like my coffee budget is its own whole category. I have a dedicated coffee routine. Like, coffee is funny, right? Because it's such a addiction and habit and like part of the economic lives of a very large portion of consumers that
I can quit anytime I want to, Alex. I'm not I'm not an addict.
I didn't mean to imply that that was you, Jason. I was talking totally about other people, of course. Well, no, I mean, it's like, and I think you make a really good point about that sort of recursive behavior that you have to make these stored wallets make sense. I mean, we're seeing stored wallets pop up in all kinds of places, and there's actually lots of new infrastructure that's designed to enable stored wallets. But I do think, pulling on that thread, there's a limit to how valuable stored wallets are, and you can't have stored wallets for everything, right? Like, imagine a future scenario where what all of the companies we're interacting with are basically requiring us to do is store money in their ecosystems in order to transact with them. Like, how do I manage that as a consumer? I can't have 20 different stored wallets with varying amounts that I can't keep track of. Like, this is not going to work at scale. And so I do think Klarna, if they want to go down this path, which they are already doing in the EU, in the US, they should approach this more from the perspective of a bank partnership. And maybe they'll circle back around to that. Maybe this was just launching something in the meantime, but I think to actually get user adoption, you have to add more value here than just making it slightly easier to transact in the Klarna ecosystem. Jason, can I keep us in the BNPL tranche, but move us on to a different story?
Yes, please do.
Okay, so my next one is Affirm, which just reported its Q4 earnings. And I will say, just as
they
a
do
side
fiscal
note,
year. It's confusing.
I don't like it. I don't like it.
Yeah.
I used to work at FICO, and they did the same thing. They had fiscal year earnings, and so like, hey, Q4 is coming up. I'm like, no, it's not. We're not in Q4. What's happening right now? This is. did I time warp? Like, no, it's not Q4. So please don't do that. My brain is like busy enough already. I can't keep track of these things. So don't trick me into thinking it's Q4. But I guess Affirm was able to communicate to the market that they had a pretty good quarter. So let me run through some numbers because, Jason, I know before all else you are a stock market analyst. That's how you think of yourself. So let me just run the numbers for you, if I might. Affirm reported for Q4 2024 loss per share of 14 cents, which was lower than the 51 cents that was expected. So they lost money, but they lost less than they thought. Revenue was 659 million versus 604 million expected. So they came in over on revenue. They reported a gross merchandise volume, which is a key metric that they use in Buy Now, Pay Later to describe the volume of transactions that they're enabling through their network, of $7.2 billion, which is a very big number, which is up 31% from a year earlier. Revenue was a 48% increase year over year. And again, their net losses narrowed to 45 million from 206 million from a year ago. So Affirm seems to be doing well. They also reported that their number of active merchants that they have hit 300,000, and active consumers also grew by about 19% to 18.6 million. So, Jason, stock market analyst that you are, I would love to get your reaction to those numbers. And I guess the larger framing that I'm thinking about with Affirm, and it's been such a roller coaster ride because, like, rates go up, their stock price goes down. They announce a partnership with Shopify. Their stock price shoots back up. Then there's maybe a slightly slow quarter of growth in GMV, and then their stock price goes down. I mean, the market seems to have a very volatile relationship in a lot of ways to Affirm, which is strange because when I look at Affirm, I see a company that is very disciplined about risk management, and that is just kind of slowly but steadily churning through a roadmap that includes partnerships with big companies like Shopify, Amazon, Apple was a big one recently that the market was very happy about. Executing against a product roadmap that includes their debit card that has BNPL functionality built into it, and just kind of churning out a relatively good business, even though interest rates are still high and consumer credit utilization has climbed back to pre-pandemic levels, or in some cases surpassed it. Affirm seems to be just kind of chugging along. What's your take?
Yeah, absolutely. I mean, I think describing the stock market perception of Affirm as a roller coaster, I think is right. I was looking back at sort of how the share price, or more specifically the market capitalization, has changed over time. Yeah. It's like when around the time of the IPO, it was like around 23 billion, peaked at like 45 billion in late 2021. So like
the heyday.
In that like crazy, like, well, maybe the worst part of COVID is over, but we think that the future has just been pulled forward. Remember that narrative? Like,
I remember that.
Yeah.
I remember that. I remember rates being so low that everyone was like, money will be free forever. This is amazing.
Yeah.
Oh, yeah.
Now with the pop they got on the earnings announcement, it's basically like 13 billion.
So whoosh,
I mean, you've seen. Well, I mean, if anything, Klarna's and Klarna is still private, so it's not like we have public market pricing. But Klarna's arc there has been even crazier, right? I mean, granted, I don't know how disciplined SoftBank is in their valuation. But it was like shot up to if memory serves like 47 billion. Then they had to do that mega down round at like 8, and now the sort of rumor mill is they're targeting an IPO around 20. Right. So a real whipsaw as far as like how investors, both private market and public market, are thinking about these companies. I mean, when looking through the shareholder letter, which I at least had a chance to briefly skim before this, I was like, I had a couple of questions that I was sort of keeping my eye out for. One was like, what are and this is kind of an obvious question, I guess, but like, what are the revenue drivers? And while it is predominantly interest income / gain on sale, so like originating the loans and then selling them and recording that the markup on the loan, a decent portion of it also comes from their merchant network. And my understanding of how Affirm and specifically Affirm's founder CEO Max Levchin has sort of positioned Affirm in the sort of long-term time horizon is to be a payment network that is potentially competitive to your Visa MasterCard duopoly. But I mean, at this point, it primarily looks mostly like a lending business. And then in the context of being a lending business, and specifically a non-bank lending business, you reference interest rates. I was also keeping my eye out for what is their cost of funds. And they've been fairly steady since the start of the year, but almost 8%, 7.7%. And I had to, this might be a little embarrassing, I had to go check, like, what is the industry-wide bank average cost of funds? And in Q1, it was like 2.5, 2.6% average. And so you do see, being a non-bank lending business, you're perennially at the whims of capital markets. In a way where, Klarna is a bank in the EU. It wouldn't surprise me if at some point they try to get a charter and branch into the US. And the benefit to that is they do have a deposit base, which I should have looked this up before we talked. But I would hazard a guess that Klarna's cost of funds is materially lower than Affirm's is.
I think that's absolutely true. And, it is interesting because when rates did go up, that was one of the like low points for Affirm, because they, I think, had some difficulty repricing everything. And the basic idea there is that, like, with credit cards, it's pretty easy because rates go up and you just have built into your terms and conditions with all of your credit card customers that, your rate is variable and it will move. And it's pretty easy to reprice credit cards as interest rates go up so that you don't have a big delta between, your funding costs going up and, the interest rates that you're charging to customers staying low. Plus, again, as a bank, if you're offering a credit card, you can keep your funding low by keeping that sticky, sleepy money and not allowing it to get repriced, as Jason and I have talked about in other podcasts. And Affirm was sort of the opposite, right? Which was its funding costs were very responsive. And so as soon as interest rates went up, the capital markets were like, no, it's not going to be that rate. It's going to be this rate. And the reverse was true on the customer side, because Affirm was going through merchants and they had negotiated pricing and interest rates and all of that stuff through individual merchant partnerships. That stuff was all difficult to reprice quickly. And so I think, it does definitely demonstrate the challenges that Affirm has in navigating sort of the broader macro environment with their model, which just is very different than the model that that banks tend to use, or bank-like companies in some ways, like a Klarna in Europe. The interesting thing to me, and you've worked in lending for a long time, so I want to get your quick take on this, then we can move on to a different story, is I do think there is a benefit long-term for a company to be able to build, like, I guess what I would call a disciplined lending business, right? And so the thing I've seen in the past that it always scares me is when you build a lending business in a great lending environment, you learn nothing, right? You learn absolutely nothing because, like, money is free, our costs are really low, consumers have the ability to take on a ton of debt, our delinquencies are really low, which must mean we're super smart and we built this great underwriting model. Like, lending is easy. And then, inevitably the macro environment changes and you get your teeth kicked in and you're like, wow, I never want to work in lending ever again as long as I live. And the thing guess have been impressed with Affirm, and that gives me some confidence for them in the future, regardless of if interest rates go down or if they stay high or whatever happens, is despite some of those rough patches we described, they seem to have built a relatively resilient lending business where they are pretty disciplined about risk. They are pretty disciplined about working with the secondary market to understand what their funding costs are going to be, being able to adjust their pricing through merchants, building a bit of a diversified business so they're not entirely dependent on lending revenue or merchant revenue. So I think in some ways the fact that they had a reasonably good quarter, even though a lot of the macro factors are not crazy positive for lending right now, is kind of a good sign. But again, it's hard to keep that discipline long term.
I mean, I think that Affirm has always had a reputation of exactly what you're saying, being very disciplined and just a high level of expertise and sophistication around credit risk. And I know that, now that we're a bit beyond the COVID BNPL bubble, maybe it's harder to remember, but I don't necessarily think that was the case for the explosion of all of the different BNPL companies that seem to pop up, over the course of a couple of years and across all sorts of different segments, right? I mean, one thing that is a benefit to doing shorter duration products is you have a faster learning cycle, right? I mean, that I spent 4 or 5 years doing payday loans. And the nice thing about that is if your repayment cycle is, 2 to 4 weeks, you can very rapidly, deploy tests in your credit model, understand what's happening, understand how they impact repayment rates. Certainly, Affirm is to be clear, not a payday lender, but the short-term BNPL is basically a 6-week repayment cycle, and even Affirm's interest-bearing longer-term loans, I think, are like probably mostly less than a year, with the exception of like the Peloton stuff, to the extent that that's still a big part of the business, and it just allows you to more quickly calibrate to changes in the credit environment.
I think that's right. And I think the other factor that's tied neatly into that is all these buy now, pay later companies that are doing a good job here. They are the home to some of the smartest machine learning engineers in the industry. And so they have a lot of analytic talent that can take advantage of those quick learning loops and all the data that they're generating to kind of iteratively get smarter about this stuff. Jason, why don't we hop through our next two stories quickly? You go first.
Okay. Our niche, Neobanks, back. It's been, Neobank has been a rough time, at least in the US market, right? We've seen a pretty pronounced consolidation, including some outright failures, particularly given the collateral damage from Synapse, which powered a number of neobanks. But names like Daylight, Cheese, Prize Pool, numerous others have shut down or been acquired or what have you. So against that backdrop, that Comune, which is a immigrant-focused neobank, raised a $21.5 million round, is certainly noteworthy, even more so given that that's actually kind of a crowded space. You have others like Maza and Majority. There's a company called Tanda, which is more focused on lending circles or Roscas. Revolut even actually kind of made a play in this segment, touting its so-called currency corridor or remittance corridor between the US and Mexico. So you've seen a lot of activity here. Commune, and I should point out, Marianne Acevedo wrote up a great piece in TechCrunch on their fundraise. Comune offers native Spanish-speaking reps available 7 days a week, which is important if you're serving a population whose native language is not English, as well as, perhaps most importantly, accepting over 100 different ID types from Latin American countries. And I don't just mean passports, but country-specific identification. So, for example, if you're an undocumented immigrant from Mexico, you can actually get what's called a matricula, which is basically an ID card issued by the consulate. And these exist for a lot of Latin American countries. I will point out that this is not actually something that is inherently new or only the province of fintech or neobanks. Of all companies, Wells Fargo has actually accepted matricula cards, Mexican matricula cards, since 2001.
Whoa.
And they currently do allow you to open accounts online using some of these alternative forms of identification. So my question to you, Alex, is there something particularly different about this segment, this population, that Comune and Maza and some of these other companies want to serve versus some of the niche neobanks that we have not seen be successful?
Yes, that is a great question. So first of all, I will say, just in terms of like a value statement, I love this. And I would like to see companies in this niche neobanking universe broadly succeed, because I like the concept of niche neobanking, and specifically niche neobanking for immigrants. I would very much like to see this work. But Jason, to your question, it hasn't worked to date. I don't think there's really much evidence that sort of B2C neobanks focused on specific customer segments have been tremendously successful. In particular, I think they're not terribly compatible with venture capital, because the expectations for VCs is that typically, and not all VCs, but for many VCs, we're looking for outlier companies that will sort of return the entire fund. And I just don't think that's a reasonable expectation for really almost any niche neobank, because your ability to serve that market, it's niche by definition. So maybe, Jason, to answer your question, perhaps the enduring appeal of the immigrant focused neobank versus Daylight, Cheese, some of these other ones we've seen kind of come and go that were focused on different niches. Perhaps there's a perception that the immigrant population is one that is going to be enduringly large and growing even bigger over time, and that it's a massive enough niche that's not well served enough that it could justify having multiple goes at it to try to figure out how to crack the code here. I think there's something probably there as it relates to VC's enthusiasm for it. Because again, anytime I see niche neobanks these days raising, $21 million, it's a really impressive fundraise. And so I always sort of have to ask, like, what is it VCs are sort of buying into here? So I think that's probably part of it. But to your point, the thing I don't really understand is, what does it take to win in this market relative to others? Because I don't, when I see Comune, it seems good. I don't see anything that like doesn't make sense, but I also don't see anything that's like dramatically different than what other folks have tried. And to your point, banks have built better interfaces to working with some of these populations. Now, there might be plenty of other reasons that someone might not want to open an account with Wells Fargo. So I'm not going to go so far as to say they're like the perfect answer to immigrants' banking problems. But, to your point, they do support certain types of identity documents. I would also note that there are folks like Nova Credit that have been enabling like credit passports and the ability for immigrants to bring their credit history from other countries with them. And so the infrastructure to do this at more of an industry level exists and is getting better, I think. And I'm not quite clear on like what the formula is that it would take to be massively successful at sort of succeeding in this opportunity.
No, that makes a lot of sense. I mean, I think one takeaway I had thinking about this segment versus some of the other niche neobanks is I do think there's a stronger argument to be made that there are unique jobs to be done
Yeah.
for the immigrant population that may not exist in, say, the GLBT population or
Yeah.
like
Yeah.
the Asian American population or people who
Hmm.
want, gambling games tied to their savings account. Particularly like obviously the identity doc stuff that we've talked about.
Yeah.
Remittances, certainly,
Yeah.
right?
That's a big one.
Of course, if I have Wells Fargo or Chase, I can certainly I can send money to Mexico, but it may not be particularly easy and it may be quite expensive. And so I haven't actually looked at Commune. I'm assuming Commune probably does this via a partnership with somebody like Wise or Currency Cloud or something.
Sure.
But building, integrating a feature like that is going to be most likely more in demand from the segment they're serving certainly makes sense.
Yeah.
There are also just some cultural differences in trust in the banking system, right? I mean, if depending on where in Latin America you're coming from, Mexico has a history, not so much a recent history, but a history of banking and currency crises. Certainly a country like Argentina or Venezuela, where just people's faith and confidence in the banking system and banks may be quite different.
Yeah.
And to the extent that a neobank like Commune sort of understands and can speak to that fear or instill confidence in a way where I doubt Wells Fargo is out there advertising their that their account can accept these identity documents, and then specifically speaking to somebody's experience that they've had in another country.
Right.
I do sort of co-sign your skepticism of like, well, but is this really a venture? Are you going to get a venture scale exit from one of these businesses?
Yeah.
I struggle to see how you get there. But should we leave it there and talk about our final topic for this month?
We should. So last topic before Jason and I rant for a minute at the end of the podcast is Apple opening up NFC. Sort of. As folks probably know, historically, Apple has not allowed third parties to access the near-field communications capabilities built into its devices, which is a necessary component to enabling in-person contactless payments. So that ability to tap your phone on the point of sale system and have it functionally be able to make a payment that requires access to the NFC chip. Apple has restricted that and has made it exclusively the province of Apple Pay. However, what this means is that it has been perceived, I think, in kind of an anti-competitive lens, and Apple is facing a tremendous number of sort of different anti-competitive sort of inquiries from governments around the world. And in particular, I believe they just entered into an agreement in Europe where they have been sort of under assault on many of these fronts to open up access to their NFC chip. And so perhaps trying to forestall being forced to do that in other jurisdictions, Apple has made the pivot to being able to open up their NFC chip to third-party developers. Yay! Everybody gets access to the NFC, except that there is one specific note, which is that anyone who wants to take advantage of Apple's sort of APIs that they're building into their operating system that would allow them to tap into the NFC capability on Apple devices will need to enter into a commercial agreement with Apple, request the NFC and SE, that is secure element entitlement, and pay the associated fees. Now, we don't know what those associated fees are or what the details of this commercial arrangement are, but I think Simon Taylor put it pretty well in his newsletter the other day, like, heads Apple wins, tails you lose is sort of the general mantra
fair enough
for Apple. And so that's fair. And, while they are maybe perhaps retreating a bit from we're the only ones who get access to this capability, that is a strategic retreat to the bridge of we still want you to pay us our 30% or whatever the equivalent will be in this particular scenario. So I guess, Jason, the questions here are, how big a deal is this really? Because we do have other ways to enable in-person commerce. Certainly, Cash App and others have figured out Toast. The ways to do in-person commerce that can rely on QR codes, on other forms of sort of technology. So NFC is not the only game in town, even though it is a pretty good experience. And I wouldn't necessarily think that everyone would be super jazzed about paying fees to Apple for this. So what's your take on how big a deal this is going to be?
I don't think it's a particularly big deal. Android, as I understand it, has always permitted access to NFC. Yes. And, in the US, Android is approximately 50% of the market. In other countries, substantially more. And I'm not aware, at least in the US and Western Europe, I'm not aware of, high penetration of competitive wallets outside of what is already part of the OS. So whatever Google has rebranded its wallet to this year, I'm not aware that that's a deep cut.
That is a deep cut, but for those who know,
Yeah. So even if Apple opened this up without, putting a toll booth in there, which they love to do, it is not clear to me that at this point there's space for, a PayPal or a Cash App or a Venmo or whomever to effectively compete and win a meaningful market share. And then to your point, I guess I'll make the second obnoxious Starbucks reference of this podcast. It's been demonstrated that where there is a strong enough value proposition, consumers will use QR-based payments, right? So I don't. This feels more like a Apple GR move to placate antitrust regulators, more so than like a legitimate, like, oh wow, like this is really going to change, the mobile payments landscape, because I really I don't see that happening.
Yeah, I think that's a really fair point. I mean, the thing about mobile payments that I find really strange, we've been talking about it forever. Like, mobile payments as a topic within this industry is like older than I am, which is insane. But like it goes back decades of like, what if we enable this thing? And if you go back to the very early days of PayPal, before it was called PayPal, that was what they were building, was like, the ability to make payments or transfer money from people's Palm Pilots. So like it's not new, and yet I find, Jason, that mobile payments, like, user adoption is always kind of halting, right? Like it makes progress in one specific area. I guess if you live in New York, you might use it for like transit passes, because it's easier to just kind of, you already have your phone right there and you just sort of go over the thing, and you want it to be as fast and seamless as possible. So it takes off in certain places. I will tell you, I don't see it a lot in Montana. We still use gold bars to pay for stuff out here, so it doesn't have
you and bribes to Bob Menendez.
right. That is a deep cut. I think that we overestimate maybe how much people really want NFC and mobile payments. And to your point, if you have a sufficiently strong sort of reason for consumers to adopt whatever your little payment method is, you can actually ask them to go through a lot more friction. So I guess the point is the Venn diagram of I want to use my mobile phone rather than using a card or some other form of payment, and this is going to be worth it enough to me as a consumer to choose to do this. Like the overlap of like, oh, I am definitely committed to doing this with my mobile device, but I only will do it if it's NFC and it's really smooth and a nice experience. Like there might not be a lot of room between those two poles. And so I do wonder if this is more of like, it's a cool thing to announce, but doesn't actually change anything in the market. The other quick point I want to make, and just bounce this back to you before we wrap up, is I do think it is interesting that Apple has now done a couple of different things. The stuff they're doing around buy now, pay later, where they seem to be pivoting to much more of a, we want to be open to other people using our infrastructure than trying to selfishly just use it ourselves, right? So who knows if NFC becomes like really popular as a way to enable mobile wallets. As we've talked about, that might not be quite as big a deal as we might think it would be. But Apple seems to have definitely shifted its mindset, and it could just be for antitrust reasons, it could be for other reasons, but they seem to have adjusted their mindset from, we want to be the one offering the product exclusively using our infrastructure that we won't give access to anyone else to we might still offer Apple Pay or Apple Card or whatever, but we want to open this up and have more providers sort of vying to use our infrastructure. It does seem like they're trying to sort of reinvigorate maybe their partnership ecosystem built around some of the infrastructure that is relevant in financial services. Does that resonate at all?
No, that makes sense. And I realize that you and I are very, or perhaps somewhat narrowly focused on like the payments use case. So basically, is this going to engender a competitor to Apple Pay, which I don't think is the case. But there are other use cases for NFC, right? I'm traveling a zillion times in the upcoming months, and it's like, okay, mobile boarding passes are great, but you still have that awkward, like, oh man, like I'm trying to scan it at TSA, and like it's like weird. Right. You could imagine like, oh, okay, now the Delta app allows you to tap your ticket. Obviously, this would require like new hardware, and it would take forever to roll out, and only like nerd travel early adopters would probably use it. But you can imagine things more in like the tickets or passes use case, and not necessarily like trying to compete with Apple Pay, which I just think is probably a losing battle.
Yeah, I think that's right. And like as it gets into identity, travel, other use cases, I mean, you always have to remember with Apple, like they're playing in every industry simultaneously. So even though we're sort of financial services nerds and we get involved in like payments, and that's kind of how we look at this, Apple has just as much of a stake in travel, in government identity, in healthcare, and all these other use cases where NFC could be valuable. So I think that's a good place to leave that one. Jason, let's quickly mention our Can't Let It Go topics. I'll go first because I think you have a slightly longer list this month. My Can't Let It Go is credit building, which is always my Can't Let It Go. But specifically, I will mention there was an article that was fairly good, I thought, in terms of it writing in a balanced way, in the Wall Street Journal, written about credit builder products. My Can't Let It Go is, and I don't try to make this request too often, but if you're going to write about credit building, please talk to me. Please interview me. Please, I wouldn't mind being quoted in your story. Like, credit building is the one topic that is going to be like mentioned at the top of my tombstone after I die. So please, like, do me this favor. Talk to me. I'm happy to share some insights that you might not get from other people. I beg of you, because credit building continues to be eternally my Can't Let It Go topic. Jason, how about you?
I have to co-sign Alex's request. I think he has spent more time thinking about that than possibly anybody else in American fintech.
I think that's true.
I will try to keep it brief. We've already sort of hashed through the Starbucks is not a bank. People, please stop using the Starbucks. It's really a bank. It is not a bank. It is a stored value card. You can only turn that value into coffees and mediocre pastries. You cannot turn it back into money. I did appreciate some Twitter chatter about, I only caught like part of it, but something about like a run on the like Lehman Brothers cafeteria because people had like stored value cards. And like when Lehman was failing, and Kia, correct me on Twitter if I'm getting this wrong, there was like literally a run on the non-bank to like get the value out of the card by just like buying anything they could buy, which I guess if Starbucks is going bankrupt, there's going to be a run on coffee. And then very briefly, I'm not sure if folks, if I've expressed that I am a unrepentant political news junkie. One of the podcasts I listened to today was informed me that Trump's NFT grift is back, although I think he's referring to them as virtual trading cards.
Yes.
Including one of them, which I've pasted here in our outline. Sadly, this is an audio medium.
Just take my word for it. You're lucky it's lucky it's an audio medium.
Basically, it's Trump in something that looks like an Iron Man suit.
Yes.
With a giant like Bitcoin logo in front of him, which you can buy for the low price of $99. And if you buy enough of them, you can even go to dinner at Mar-a-Lago. So this is not a political podcast. I'm not expressing an opinion one way or the other about any policy position. But I do think the NFT thing, it just needs to die already.
I really sincerely wish it would. There have been a couple NFT headlines lately where I'm like getting these weird, like kind of post-traumatic stress flashbacks to 2021. But I will say I did watch the video in which Trump announced this new run, I guess, this limited edition of trading cards. And the line that I would haunt me if I was a Bitcoin person or a crypto person, and would really make me consider all my choices again very carefully, was him saying, some people are calling me the crypto president. I don't know if that's true, but some people are saying it. The casualness with which all this stuff is like, hey, look, an opportunity to grift over here, an opportunity to tell people what they want to hear for some other reason over here. Like it's endless, and just be very cautious about who you tie your boat to, because I don't think any of this is in any way serious.
We should just leave it there, because I do not want. You're going to make me go on like a rant about how the crypto industry apparently accounts for almost half of all corporate donations in 2024. Which is mind-boggling that there is that much money to donate to basically try to get your preferred policy outcome.
As long as we make the number go up, Jason, then we're good. We're good to go. It doesn't matter what else we do. All right. Well, as long as we make the subscriber numbers for this podcast go up, Jason and I are happy. We hope that you enjoyed today's podcast. As Jason mentioned at the top, we are going to be in New York at Finovate Fall, where we are very excited to be speaking on stage. Jason apparently is only going to be on stage in New York. He's never allowed off the stage. So if you'll be there, please come track us down and say hi in person. And Jason, I can't wait to do this again next month.
Yeah, I'll see you in New York.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.